Investing in rental grade properties is a great opportunity to build wealth, to provide cash flow. It's also a great opportunity to go broke. Investing in rental properties, it's one of the oldest businesses on the planet, and really it's the way people get rich. But that said, being able to evaluate which properties are going to be winners and losers is very important. In fact, it's the most important initial step that you need to take when you're thinking about buying a rental. When I evaluate my rental properties, there's three basic areas that I look at. The first is going to be the income. This is what most people look at, and it's usually all they look at. Income includes two different categories. We've got cash flow and we have long-term income. Cash flow is the stuff that you got paying your bills. Typically it's a few hundred to a few $1,000s a month, depending on the size of the investment. But how to evaluate your cash flow? This is going to be your monthly income, any rental income that you might receive, also any income that you might get from things like coin-operated laundry or an advertising space on the building or something like that. So it's money coming in. Minus your expenses. Most times people underestimate their expenses. This can be anything from the mortgage, taxes, and insurance on the property, but it's also going to include managing the building. It's also going to include maintenance, cleaning, lawn care, snow removal. It's also going to include a reserve so that when these big ticket items pop up in the course of your ownership, you're not left, excuse the metaphor, but with your pants down. You want to compensate for all these things when you're evaluating cash flow. Cash flow is, though it's not the most important part of a real estate investment, it's certainly something that has to be considered. You need to, having a positive cash flow property is really, can be a make or break. You can buy one property if, there's a negative cash flow and it's eating up some of your personal income. You might be able to buy two or three, but there's going to be a certain limit if you're losing money on those investments every month. However, if you have a positive cash flow, every time you buy a property, it's putting more money in your pocket. So we're looking for positive cash flow, typically ranging from a couple $100s up to a couple $1,000s a month. The next indicator here is long-term investment, long-term returns. You probably, a second ago when I said you lose money every month, you're probably wondering why the heck would you lose money every month? Well, with long-term investments, if your goal is 10, 20, 30, 50 years out for an investment, these long-term investments are really fantastic. The payoff is incredible. The first thing that you're going to see over that long term is appreciation. Think about a property that you could have bought 20 years ago. It's probably worth more now than it was 20 years ago. In addition, you've got leverage. Let's say that 20 years ago you bought a house for $100,000. Well, you're not putting $100,000 down on that house. Maybe you put $10,000 down and you pay over time. And as an investment property, you get to use other people's money to pay that mortgage off. So you got a $100,000 property, costs you $600 a month in mortgage. You rent it for $900 a month. And today, that same $100,000 property is worth $200,000. And and the value is $200,000, but your principal that you owe on the mortgage is $10,000. You didn't come out of pocket to pay that. Other people did. And then, over time, you're building equity in this rental. And that kind of touches on the same thing. That's done using other people's money to pay your mortgage, to pay the bills, to upkeep the property. And you continue to build more and more equity and increase your net worth as time goes on. The second point that I use in property evaluation is the area. This is going to have a direct positive or negative effect on the income. I put my properties in a range from 1 to 10. 10 is like Trump Tower. It's gorgeous, high-end, very expensive, very nice. 99.9% of these properties are owner-occupied properties. Then we got the other end. And these are the slums. They're the kind of place that you wouldn't walk down the street, walk your dog down the street. You wouldn't wish them on your worst enemy. Most of the properties are boarded up. high crime rate. The people that live there oftentimes don't own them, but nobody really wants to own those properties, all right? As you go up the ladder here, from 1 to 10, the percentage of owner-occupied properties goes up and up and up and up and up. Towards the higher end of this spectrum, buyers will pay more than investors for properties because they're intending to live in those properties. So a handyman special that you might see as an opportunity, the discount is going to be much less than the repairs. It's difficult to make money on this end of the spectrum on a cash flow basis. On a long-term basis, this is the area that's going to have the most appreciation. On the flip side, in these lower end properties, because you can pick them up for just a few dollars, your cash flow is going to be much better than it will be on the Trump Towers. So what I try to do is, I try to invest somewhere between a 4 and a 7. On the lower end of the spectrum here, I'm anticipating buying the property in cash, doing some repairs, and renting it out. It's a cash flow investment. If I can never sell that unit, it doesn't matter. I'm making my money in cash flow. On the other end here, when I'm investing in these 7s, these are typically areas where my cash flow might be a break even. But I'm looking at the trends in the market and I'm seeing that, okay, it looks like this area is improving, and over time the appreciation is just going to get better and better and better. And even if it doesn't appreciate, I'll be able to fix the house up for a few $1,000s in 20 or 30 years and sell it to an owner-occupant who is, like I said before, going to pay a little bit more for that property than an investor would. So you got to look at the income, but you also have to look at the area, and these kind of go hand in hand when doing this evaluation. And our third evaluation factor is going to be our objective. This is the why and how soon for your investment. Why are you investing, and how soon do you need the money back? With the why, what we're looking at is, maybe you want to buy a rental property so you can make a couple extra $100 a month. Well, if that's your objective, then you probably want to be in the lower end of this area spectrum, because that's where you're going to have the best return on your money for that investment, the best cash flow. If you're looking, however, to do, to plan for your retirement, and any cash flow is just going to go into an account and sit there for when you retire to pay your bills and things like that, well then in a situation like that, you're really looking more for the long term. You'll be able to take advantage of more of the appreciation, having other people's money and the leverage that you're going to get there, paying off your expenses. So in that instance, you probably want to be a little bit higher up on this area spectrum so that you're able to get something that's a little bit more in the owner-occupied neighborhoods that will, while it won't give you a larger cash flow, the appreciation is probably going to be greater. So again, these are the 3 areas that I'm using to analyze a rental investment. First is going to be the income, either cash flow or long term. The second is the area, and anywhere from the slums to Trump Tower, and determining where you feel comfortable and where you're going to have the best returns. And number 3, your objective. Why and how soon do you need these returns? So I hope this helps next time you're going to evaluate a rental property. Until I see you next time, best of luck in your real estate investing.